Buy the dip. It's the ultimate mantra of the long-term investor. And honestly, historically, it works. If you bought the S&P 500 during every major crash of the last 30 years and just held, you'd be doing great. So, here's the million-dollar question. If buying the dip always works in the long run, why on earth would you bother to trade? Why deal with the stress, the RSI levels, and the daily charts? Today, I'm going to show you why simply buying and holding is actually one of the most inefficient ways to use your capital, and how combining short-term trading with long-term investing creates a disciplined trader feedback loop that outperforms the market. The dead capital problem. The biggest myth in investing is that time in the market beats timing the market. While true for beginners, it ignores opportunity cost. When you buy and hold, your capital is a passenger. It's sitting there, waiting for the macroeconomy to lift it. But markets don't move in straight lines. They oscillate. If a stock goes from $100 to $120, then back to $100, and finally to $130 over 2 years, the buy and holder is up 30%. The disciplined trader sold the overbought RSI at $120, moved that capital into a different undervalued asset, and bought back into the original stock at $105. By the time the stock hits $130, the trader hasn't just captured the 30% move. They've compounded their gains multiple times while the holder was just waiting. Here is exactly what I do on a daily basis. I look for rotation. I'm not saying technical indicators have zero value. Some help greatly. I use the RSI, Relative Strength Index, as a thermometer. When an asset class is deep in overbought territory, the probability of a pullback is high. Instead of sitting through that pullback like a diamond hands enthusiast, I rotate. I take profits from the high RSI assets and move them into the assets with the lowest RSI, the ones that are currently being ignored or dumped. This is the key. I'm not gambling on random stocks. I'm rotating between high-quality asset classes that I'm certain will go up in prices in the long run. It's about taking the energy from one winning trade and using it to fuel the next dip before it even starts to recover. Let's be clear. This video is about long-term investing. I believe fundamental trading always wins in the long run over pure technical analysis. Technicals tell you when to move. Fundamentals tell you what to buy. If you only use technicals, you're just chasing ghosts. But if you only use fundamentals, you're leaving money on the table by ignoring the natural rhythm of the market. Trading is simply the tool we use to maximize the efficiency of our long-term fundamental convictions. You don't have to choose between being a trader or an investor. The most efficient path is being both. By trading the short-term noise, you generate the extra cash flow needed to buy even more of the long-term dips you believe in. You aren't just waiting for the market to give you a profit. You are actively extracting it. Let's stop being passive passengers and start being disciplined traders. Thanks for watching. Please like and subscribe, and also check out the helpful resources I listed in the description box below.